Hello friends, welcome back to JK Shah classes. Today we will be revising for CA final direct tax. We will be revising part 2 of special provisions for non-residents and foreign company. In part 1 we discuss residential status, scope of total income. We discuss provisions of other chapters like minimum alternate tax, TDS, Aadhaar number, that is assessment procedure chapter, etc. and presumptive taxation scheme and something from capital gain, something from PGBP, something from capital gain. In this part 2, all these things we discussed in part 1. Now in part 2, we will be discussing mainly exempt income, and I will be recording a separate video for place of effective management, POEM, for foreign companies, for determining residential status of foreign company. In this video, we will be learning only about exempt incomes, incomes which are exempt under section 10, various clauses of section 10 pertaining to non-residents and foreign company. There are around 20 to 23 exemptions. Some of them are important, some of them are unimportant. I will keep on telling you which all things are important. The very first one is section 10. In your notes, if you can see section 10, the very first one is 10 clause 4 subclause 2. It is to be pronounced as section 10 clause 4 subclause 2. This is not subsection 4, huh? Please be very careful. This is NRE account interest, non-resident external account interest, applicable to non-resident, but here the assessee should be non-resident as per Foreign Exchange Management Act, which is almost similar to Income Tax Act provision 182 days. In FEMA, there is no concept of 60 days or more, there is a concept of 182 days or more. FEMA you have already studied in law subject at Inter CA, you must be recollecting some provisions. NRE account interest, that is whether it is savings account interest or it is FD account interest, both the types of interest, if it is deposited from NRE account, non-resident external account. This is slightly important, that's why I discussed it in detail with you. 10(4)(c) is also slightly important. Interest on rupee denominated bonds, again applicable to non-resident or a foreign company. Interest on which bond? Rupee denominated bonds, which are also called as masala bonds, provided such bonds were issued between 17 September 2018 to 31st March 2019. Between these two dates, then only. Then the next is 10(4)(d), which is less important, slightly important but not very important. 10(4) and 10(4)(c) are important. 10(4)(d) is okay, not very important and not even to be ignored also. This is applicable to specified fund. What is specified fund? I told you in some chapter called DTAA also, TDS also, and special rates of tax also, chapter 12. Supposingly this is India and this is USA. We had discussed it in detail in a chapter called special provisions for or special rates of tax, chapter 12. This is USA. Here there will be some FII. FIIs, foreign institutional investors, are incorporated in USA, incorporated in foreign country. Suppose it has 3 investors, A, B and C. Mr. A, Mr. B, Mr. C, all 3 of them are residents of USA. So FIIs, they come to India, but they have investors located in foreign country, residents of foreign country, as well as FII is also incorporated in foreign country. They come to India for investment purpose. On the other hand, what is specified fund? Specified fund is the one which is set up in India, which is incorporated in India, specified fund, and it has also investors located or registered or incorporated or residents of foreign country. Let's say Mr. P, Mr. Q, Mr. R. P, Q and R, they are investors of specified fund or unit holders of specified fund. So only difference between FII and specified fund is that specified fund is incorporated in India and FIIs are incorporated outside India. That is the only difference. Coming back here, so which kind of income? Income of specified fund, ideally capital gain from transfer of various assets, primarily 3 assets. Capital gain, whether long term or short term, arising from transfer of bonds or GDRs of Indian company referred to in 115 AC. Number 2, derivatives. Number 3, rupee denominated bonds. And number 4 is any other security as may be notified. Up till now nothing is notified, provided transfer takes place through a recognized stock exchange located in International Financial Service Center, IFSC, Gift City, Gandhinagar, and the consideration is entirely in foreign currency, then it will be exempt. 4 types of assets, which are practically 3. capital gain arising from transfer of bonds or GDRs of Indian company referred to in 115 AC, rupee denominated bonds or derivatives, provided such transfer takes place in a recognized stock exchange located in IFSC and the entire sale consideration is in foreign currency. These 6 conditions are satisfied, or rather 3 conditions plus 3 types of assets, then in the hands of specified fund such capital gain will be exempt. However, there is a condition that provided all unit holders or all investors are non-resident, except in case of units held by fund manager who will be resident of India, except of units held by fund manager, all the unit holders should be non-resident. And exemption will be available only to the tune of that many unit holders, or exemption will be available with regards to that much percentage of income which is same as the percentage of non-resident unit holder out of total unit holders. For example, in the specified fund, 98% unit holders are non-resident and 2% unit holders are resident. Then in such situation, whatever capital gain arises from transfer of these 3 assets, 98 supposedly 1000 crore rupees is a capital gain amount, long term or short term. Out of them, 980 crore pertains to non-resident investors and 20 crore pertains to resident investor. 20 crore will be taxable. Exemption will not be available with regards to this, but exemption will be available under section 10(4)(d) with regards to that much income, 10(4)(c), that much income which pertains to non-resident investors or non-resident unit holder. Are you clear with this? This is an important point. Keep it in your mind that not entire income will be exempt, but only certain income. Or to the in respect of units held by non-residents, or income which is attributable to investment division of offshore banking unit, attributable to the investment division of an offshore banking unit. This was introduced in 2022-23 assessment year. What is offshore banking unit or what is investment division? That is clarified. Investment division of an offshore banking unit means investment division of a banking unit of a non-resident which is located in IFSC, and plus few more conditions that it has commenced its operations on or before 31st March 24 and has been granted certificate of registration as category 1 FPI, category 1 foreign portfolio investor, and registered under SEBI and regulated by SEBI regulations 2019 pertaining to FPI. Okay, so that much income which pertains to non-resident investors or pertains to investment division of a offshore banking unit. Then some amendments were carried out. There was a condition, and there is a condition, that all unit holders should be non-resident except of units held by fund manager. However, what about those people who were non-resident unit holder at the time of investment, at the time of acquisition of units, but became resident at a later point of time? Then there is a relaxation that provided unit holder was a non-resident at the time of acquisition of the units of specified fund, but became resident at a later stage, provided the number of units held by such unit holder in terms of numbers as well as in terms of value does not exceed 5% of the total units or total value of all units. Okay, this condition that all unit holders should be non-resident, all units should be held by non-resident, will not apply if the unit holder was a non-resident in the year of issue of units but becomes resident in any subsequent year, provided aggregate value and the number, aggregate value as well as aggregate number of units held by such resident unit holder do not exceed 5% of the total units issued, plus they fulfill other conditions. 5% you will have to remember. To the tune of 5%, the unit holders were non-resident at the beginning but became resident at a later stage, then no problem. This condition will not be deemed to be violated. Exemption under 10(4)(d) will continue to be applicable. 10(4)(d) rather, not 10(4)(c), 10(4)(d). Okay, then next 4, 10(4)(e), F, G and H are totally unimportant. Okay, if you want to do it, you can do them, but otherwise totally unimportant. One point can be understood as slightly important is this, that capital gain arising 10(4)(h), capital gain arising from transfer of equity shares, only equity shares of such a domestic company which is located in IFSC, which is a unit of IFSC, plus is engaged primarily in the business of leasing of aircraft, plus has commenced business operations on or before 31st March 2026. Capital gain. Now there are two clauses, one is 10(4)(h) and also you can refer to 10(34)(b), which we will be discussing in some time. Both are in connection with each other. Who should be the transferor? Which income? Capital gain. Capital gain arising from transfer of equity shares. Only equity shares, no preference shares, no debentures, no bonds. Capital gain, long term or short term, arising from transfer of equity shares of a company which is a domestic company which is located in IFSC, plus is engaged in the business of operating aircraft or leasing of aircraft and has commenced operations on or before 31st March 2026. That is fine. Who should be the transferor? Transferor should also be non-resident or unit of IFSC. The company whose shares are transferred, whose equity shares are transferred, should also be a domestic company. Domestic company located in IFSC whose primary business is to lease aircrafts or give aircrafts on lease. And who should be the transferor? Transferor should also be non-resident or a foreign company or unit of IFSC which is engaged primarily in the business of leasing of aircraft. So the person who is transferring the shares and the company whose shares are transferred, both of them should be primarily engaged in the business of leasing aircraft. Then only this exemption is available, provided transfer takes place within the first 10 years, starting with the previous year in which such domestic company commences its operation, and the operations have to be commenced on or before 31st March 2026. Now 31st March 2026 is not relevant. Primarily what you need to understand is this, is equity shares, whose equity shares are getting transferred, equity shares of a domestic company which is located in IFSC, that is also okay, plus commences operations on or before 31st March 2026, located in IFSC. Which business should it be engaged in? Should be engaged in the business of leasing aircraft. And the person who is a transferor, person who is transferring the shares of such company, equity shares of such company, the transferor should also be a non-resident or a unit of IFSC, International Financial Service Center, engaged in the business of leasing aircraft. Both of them should be engaged in the business of leasing aircraft. The person who is engaged in the business of leasing aircraft is selling equity shares of a company which is domestic company which is again engaged in the business of leasing aircraft. This is 10(4)(h) and exactly same kind of exemption, but everything remaining same, but the type of income gets changed. Here what is happening, which income is exempt? Capital gain, long term or short term, arising from transfer of such shares, equity shares. And in 10(34)(b), where we will be discussing in some time, everything remaining same, this person which is engaged in the leasing of aircraft is earning dividend from the equity shares of domestic company which is again engaged in the business of leasing aircraft. Okay, everything remaining same, one is on capital gain and another one is on a dividend from the same company. So just keep it in your mind. So I'll show you 10(34)(b) right now only, so you'll have a better nexus. 10(34)(b) if you refer to, with effect from AY 24-25, dividend from a company which is unit of IFSC, primarily engaged in the business of leasing of an aircraft, received by same person, unit of IFSC, primarily engaged in the business of leasing of aircraft. Okay, everything remaining same. If you can correlate it between 10(34)(b) and 10(4)(h), then you will have a better understanding. However, there is one extra condition with regards to capital gain, whether long term or short term, that the shares should have been transferred within the first 10 years of the operations of the company which is located in IFSC. This company whose shares are getting transferred, that company, it should be first 10 years of the operations of that company. 10(6), clause 2, clause 6, clause 8 and clause 11 are slightly important. Understand very clearly. Clause 6, subclause 2, 6, 8 and 11. 4 are next 4 points. Understand them. Section 10, clause 6, subclause 2. If you don't recollect the subclause number, that's absolutely fine. Just try to remember section 10, clause 6. Clause number try to remember. Here, the person who is a diplomat, that means a person who is resident of India, may be resident of India, may be resident of USA. Suppose any US government has its embassy in India. If somebody wants to apply for US visa, will have to apply to US embassy in India. Who will be working in US embassy? Naturally, person who's citizen of USA. He will be sitting here in India granting visa or rejecting visa application. So the person who's US citizen working in India for US government, working in an Indian embassy, such persons are called as foreign diplomat. Income of such foreign diplomat, which is salary income, which is received from government of USA, government of foreign country, for services rendered in India. Where are the services rendered? Services are rendered in India. Salary is received also in India. However, it will not be taxable in India. It will be exempt in India, provided certain conditions are satisfied. Now that person is staying in India, he should be citizen of USA. He should be citizen of that foreign country. But as far as residential status is concerned, he might have become resident in India. So residential status we are not commenting upon. He should be individual, not being citizen of India. His citizenship only matters. His residential status does not matter. That is a key point to be remembered. He should not be citizen of India. He should be citizen of his foreign country. Remuneration, that is salary of foreign diplomat and their staff members, provided most important condition is our people working in their country, their salary in their country, in that country. Indian diplomats working in USA, their salary in USA ideally accrues in USA, should be exempt in that country. Meaning thereby give and take principle. Our Indian diplomats working in USA, if US government does not charge tax to our people there, then we will not charge tax to their people in our country. Remuneration received by our corresponding government officials or member of staff who are residents of such foreign countries should be exempt in USA. And second condition is okay, that these foreign diplomats or their staff members should not be engaged in any business or profession in India. Should be subjects of respective countries and should not be engaged in any other business or profession or employment in India. Should be working only for US government, should be working in India except of salary, no other income should be there. No other income as in no business or no profession and no employment. They can have other source income, investment income, house property rental income, that is no problem. Okay, this is an important point, keep it in your mind. Condition is that he should not be citizen of India. That's the only condition. Residential status is immaterial. Section 10, clause 6, subclause 6. This is okay. Remuneration, again remuneration. All four. Section 10, clause 6, subclause 2, subclause 6, subclause 8 and subclause 11. All four are remuneration, in a sense salary income. Salary received as an employee of a foreign enterprise. For example, there is one employee of Suzuki Motors Corporation Limited, SMCL, Japan. Suzuki Motors employee comes to India. Say Maruti Udyog people invited some employees of Suzuki that you come to India, stay here for 1 year, provide training to our employees. In such situation, in case if that employee, Japanese employee, comes to India only for 90 days, maximum 90 days, then this exemption is available. 90 days, approximately 3 months. His salary, which will be paid by Suzuki Motors in Japan, but salary will be deemed to be accruing or arising in India. We just refer to section 912. Salary will be deemed to be accruing in that country where the salary is earned. That means where the services are provided. During that 90 days of stay, maximum 90 days, it could be 60 days also, 30 days also. During his stay in India, whatever is the period that he stays in India, for that much period, salary will be deemed to be accruing in India, because he is rendering services to Suzuki Motors Japan by sitting in India. So salary for those period, for those days is accruing or arising in India. Indian government should have a right to charge tax, but we will not charge tax to him, provided foreign enterprise is not engaged in any trade or business in India. That means Suzuki Motors should not be engaged in any trade or business in India. Is Suzuki Motors engaged? Answer no. Suzuki Motors, foreign company, is not engaged in any business or profession in India. Suzuki Motor has a tie-up with Maruti Suzuki, has tie-up with Maruti Udyog. Japanese company Suzuki, Maruti Udyog India, they have collaborated and formed a new company, joint venture company called Suzuki Motors, or they've formed a new company, Maruti Suzuki. One is Maruti Udyog, government company, which is Indian company. Second is Suzuki Motors, SMCL, Suzuki Motors Corporation Limited, Japanese company. They have a third company called Maruti Suzuki, which is a joint venture company, which is a public listed company. So Maruti Suzuki whatever business Maruti Suzuki is doing, we cannot say that Suzuki Motors is doing business in India. Suzuki Motors is not doing business in India. They are just earning royalty income. They have purchased 76% shares of Maruti Suzuki. They are earning dividend income and they are earning royalty income. Okay. Provided his stay in India does not exceed 90 days in aggregate. These are the two conditions, and there is one more condition which is slightly off the track, but before that, which income, whose income are we talking about? We are talking about income by way of salary of employee of Suzuki Motors who comes to India for up to maximum 90 days, and he earns salary income in India because his salary is accruing in India. Whether salary is paid by Japanese company Suzuki Motors Corporation Limited or the salary is paid by Indian company for that much period, say he stayed in India for 45 days, which is 1.5 months. During that period, salary is paid by Maruti Suzuki in India, or it is paid by Maruti Udyog Indian company, or it is paid by Suzuki Motors. Come what may be, whosoever pays, salary is deemed to be accruing arising in India. If the salary is paid by Suzuki Motors Japan, then it will not be taxable, provided he is salaried employee of foreign enterprise and he is not a citizen of India. Just like previous subclause, he should not be citizen of India. His residential status is immaterial, but he ideally should be non-resident. He would be non-resident, but ideally he should be not an Indian citizen. That is the condition. Provided there is one more condition, three conditions. First condition we are done with. Foreign enterprise, that is Suzuki Motors, is not engaged in any trade or profession in India or business in India. Second condition, stay period of that employee does not exceed 90 days. And third condition, such remuneration is not tax deductible in the hands of Suzuki Motors Japanese company. Remuneration is not liable to be deducted or not eligible for deduction from the income of employer chargeable under Income Tax Act. So, is Suzuki Motors liable for any tax in India? Do they have any taxable income in India? Answer yes, they have royalty income from Indian company. They have royalty income for providing technical know-how, and secondly, they will be earning dividend income from their investment in shares of joint venture company. So, dividend income and royalty income, two types of incomes they are earning. Suzuki Motors is earning two types of income from India. Both the incomes are taxable in India, and the remuneration which they paid to this employee, let's say Mr. X, that remuneration should not be tax deductible from that income. That is obviously. Next is 10(6) subclause 8, salary, again salary for his employment on a foreign ship. Salary from employment on a foreign ship, provided total stay does not exceed 90 days in India. Here also, just like previous subclause, the stay period in India should not exceed 90 days. Which employee are we talking about? Again, he should not be citizen of India. Plus, he should be non-resident. He is an individual, salaried employee of a foreign ship. Foreign shipping company has appointed him. But why does he come to India? He does not come to India for vacation. He comes to India as a part of crew member of the foreign ship. Foreign ship is traveling. It is sailing all around the world. When it comes to India, when the moment it enters the Indian territorial waters, which we know is up to 12 nautical miles from the seashore, from the landmass of India, up to 12 nautical miles. When that ship enters Indian border, Indian territorial water, ship is still in the middle of the water. The captain of the ship or the crew members of the ship have not stepped out of the ship. They are still inside the ship, but they will be deemed to be present in India. So, in case this way, the period of stay does not exceed 90 days for a foreign ship, for the employee of foreign ship, then his remuneration, whatever is accruing in India or deemed to be accruing as per section 912, how would it be accruing in India? Answer, supposingly he is in India for 4 days, again the ship leaves India, again when the ship comes back to India, again he is in India for 2 days, 3 days. That way, total stay period should not exceed 90 days. That's a primary condition. Second primary condition, he should be not a citizen of India, he should be citizen of his foreign country. And here, he should be non-resident also. This kind of condition about residential status was not there in the previous two subclauses. It was not there in subclause 2. It was not there in subclause 6. It is there directly in subclause 8. Okay. Stay period should not exceed 90 days. And the last one, 10(6) subclause 11, remuneration. Again, if you observe section 10 clause 6, subclause 2, 6, 8, 11, all four we are talking about remuneration, that is salary. Salary received as an employee of government of a foreign state, government of foreign country, during his stay in India in connection with his training in any government office or any statutory undertaking, statutory corporation or registered society. This is okay, or I would say it is unimportant. You can strike it off. So out of these four, which are supposed to be done? 10, clause 6, subclause 2, subclause 6, subclause 8 and subclause 11. Out of them, subclause 11 is unimportant, subclause 2 is very important, subclause 6 is also important. So I'll just show you in my PPT slides. If you can observe this, section 10, clause 6, subclause 2, subclause 6, subclause 8, subclause 11, out of them, in which of the subsections or subclauses he should be non-resident? He should be non-resident in only one place, that is subclause 8. Which of them he should be not a citizen of India or should be non-Indian citizen? Answer: in all four of them. All four of them, he should be having salary income, he should be not an Indian citizen. And which of the two clauses his stay period in India should not exceed 90 days? Answer: only at two places, subclause 6, subclause 8. Okay, this is the employee of Suzuki Motors Corporation Limited. This is the employee of foreign ship. Employee of foreign ship. Okay, most important one is the 10.6 subclause 2 is important, and this subclause 6 is also slightly important. Subclause 8 is also slightly important. Subclause 11 is totally unimportant. You can ignore it. You can skip that. Okay. Then 10.6 double B, 6C, 6D, these three. Okay, this is slightly off the track, difficult to understand. It says, let me explain it to you with the help of an example. Supposingly, there is Air India. Air India has taken aircraft on lease from foreign company Airbus, US based company. Airbus and Air India is supposed to pay lease. Lease rent is 100 crore rupees for the whole year. This lease rent is earned by Airbus. Airbus is a foreign company. Being a foreign company, the tax rate applicable for the current year AY 25-26 is 35%. 100 crore entirely should be taxed at 35%. Of course, less expenditure, but assuming there are no expenditure, entire 100 crore is taxable at 35% plus surcharge plus health and education cess. Air India is supposed to deduct TDS on this 35 TDS under section 195. TDS will be equal to whatever is the tax payable. Section 195 does not have its own tax rate. It says either tax to be deducted either at the rate applicable or at the rate given in DTAA, whichever is lower. Assuming 35% is lower or there is no rate given in DTAA, Air India is supposed to deduct 35 crore as TDS. However, foreign company insisted, Airbus insisted that we want 100 crore take home. We don't understand in your Indian taxation system, we want 100 crore take home. Then what will happen? Then Air India will have to apply grossing up principle, and whatever is the tax payable will have to be paid. 35 crore will have to be, payment is agreed to be made net of tax. Foreign company Airbus wants payment net of tax. They want 100 crore take home. In such situation, the TDS portion will have to be borne by Air India. And whatever is the tax borne by Air India under grossing up principle, the TDS amount will shoot up. Instead of 35 crore, it will be more than that. It will become probably 42 crore. That 42 crore should be deemed to be extra income of Airbus. So Airbus is getting 100 crore plus TDS is deposited 42 crore in the name of Airbus in India. That 42 crore should also be extra income, should be taxable in the hands of Airbus and should be allowed as a deduction to Air India. We know pretty well. The total amount paid or payable by Air India should be deemed to be 142 crore. Out of that, 42 crore is TDS and remaining 100 crore should be deemed to be net of tax payment. But under this arrangement, Air India will get deduction or not get deduction, that is not clarified. Airbus will not be taxed for this 42 crore, which should have been taxable for Airbus, but will not be taxable for Airbus. Airbus will be taxed only for 100 crore. Will be exempt for Airbus under 10.6 BB. What will be exempt will be not 100 crore. 100 crore is taxable, lease rent. What is exempt is tax on that 100 crore which is borne by Air India, which is borne by payer. So it says, understand the language very carefully. So it says 10.6 BB, tax paid by Indian company, tax paid by Air India, which is engaged in the business of operating aircraft. Air India is engaged in the business of operating aircraft, which has acquired such aircraft or aircraft engine on lease under an agreement approved by central government, that is okay. It has taken aircraft on lease or aircraft engine on lease. Tax paid by Indian company on what? Tax paid by Indian company on the lease rental income derived by government of a foreign state or such foreign enterprise. We took example of foreign enterprise. In our example, foreign enterprise was Airbus. It could be foreign enterprise or it could be government of foreign state. Provided that government of foreign state or that foreign enterprise, ideally it will be foreign enterprise, but by chance it is government of foreign state, come what may be, that person should be engaged in the business of giving aircraft on lease, should be non-resident or a foreign company, plus should be in the business of giving aircraft on lease. Then tax paid by Indian company on behalf of such foreign company or foreign enterprise will not be taxable in the hands of such foreign enterprise, which ideally should have been taxable. I hope you people are clear with the example. In case you want to take a screenshot, you can pause the video, do the needful. I will wait for 5 seconds. 1, 2, 3, 4, 5. Okay. So that was 10.6BB. Now the next is 10.6C. 10.6BB is unimportant. Questions have never come. 10.6C and 10.6D are also unimportant. Both of them are for royalty and FTS. Royalty or fees for technical service, royalty or FTS. Royalty or FTS in 10.6C under an agreement with central government. So royalty or FTS received from central government for any project which is connected, for executing any project which is connected with the security of India. And 10.6D again royalty or FTS received from NTRO, National Technical Research Association. In 10.6C it is received from central government and 10.6D it is received from government organization NTRO, that is National Technical Research Association. Both the places the assessee should be non-resident or a foreign company, but in 10.6C it should be foreign company only. Naturally it would be foreign company only, no individual would be providing such services. Here also, though it says non-resident or foreign company, it should ideally be foreign company. 10.7 is important. 10.7. Now if you recollect, section 912. Section 912 says that salary earned in India will be deemed to be accruing arising in India. Salary earned in India. Earned in India means salary rendered, salary from services rendered in India will be deemed to be earned in India. However, 913 says that even if salary is accruing or deemed to be accruing at that place where salary is earned or where services are provided, then also in case if it is Indian diplomat working for government of India, who is citizen of India, working abroad, working for government of India, working outside India, for which receiving salary from government, then technically where is the salary accruing? Salary is accruing outside of India. Then also will be deemed to be accruing arising in India as per section 913. Which income? Salary income, which will be deemed to be accruing arising in India even though it is actually accruing outside India. Salary will include not only salary, will include perquisites and allowances also. Perquisites and allowances. However, out of these three, perquisites and allowances will be exempt in India under section 10 clause 7. In whose hands? In the hands of Indian citizen, person who is an Indian citizen. We are not commenting on his residential status. He might have become resident of foreign country or he might be resident of India for the at least initial stage. Come what may be, irrespective of residential status, if he is citizen of India, working for government of India, working outside India, then his perquisites and allowances received from government of India will be exempt. Salary will not be exempt, salary will be taxable. What will be exempt is only perquisites and allowances. So allowances and perquisites paid or allowed outside India by government of India to a citizen of India for rendering services outside India, also refer to 913 which we just discussed, applicable to citizen of India. Here person should be citizen of India. 10.7 is slightly important. We had discussed 10.7 even in 911 or 913 also. While discussing 913, we discussed this section and here we are giving a reference of 913, slightly important. 10.15 clause 2 3a is unimportant. It says interest on deposits, FD interest received by foreign bank from any scheduled bank, received by foreign bank by putting FD with any scheduled bank on deposits which are approved by RBI. provided that foreign bank is such a bank which is authorized to perform central banking functions outside India. So way we have RBI in India, same way if there is a bank which is like Federal Bank of USA, such kind of a bank, Federal Bank of Sri Lanka, such kind of banks which are performing or which are authorized to perform central banking functions. So the leading bank of that country is putting FD in any scheduled bank in India, then interest therefrom will be exempt. In whose hands? So answer, in hands of bank incorporated outside India, provided it is authorized by government of that country to perform central banking functions in that country. Unimportant, it doesn't come, questions have never come. Same way 1015 subclause 4, interest payable by scheduled bank other than cooperative bank on deposits in foreign currency where acceptance of such deposit is duly approved by RBI. Applicable to non-residents or individual or HUF who are RNOR, resident but not ordinarily resident. This is the only clause where exemption is available to RNOR also. 1030, 1015 subclause 8 we are about to discuss. Interest on deposits of an offshore banking company. Offshore banking means, offshore technically means outside of India, but here offshore does not mean outside of India. Offshore banking unit, unit means branch. Such a banking branch which is located in India only, but it's located in such a place which is considered outside of India, like located in SEZ area, Special Economic Zone, or located in IFSC, International Financial Service Center. Unimportant. So I'm striking it off. Cancel. Next one, 1015 subclause 9 also cancel. Interest payable by unit of IFSC on monies borrowed by it on or after 1st September 2019. Unit of IFSC, they are not borrowing. Who's borrowing? Person located in IFSC, which is unit of IFSC, is borrowing from any non-resident. Let's try to understand with the help of this chart or diagram. Unit of IFSC is borrowing from non-resident on or after 1st September 2019 and now paying interest. Borrowal should be on or after 1st September 19, then lifetime this person earning interest will be exempted from paying tax in India. Are you getting this point? Okay. 1034B we are done with. Okay, let's do one thing. This 1015 subclause 9 is not totally unimportant, slightly important. Okay. But remember, lifetime, this date you will have to remember, lifetime interest will be exempt once this condition of borrowing on or after 1st September 19 is satisfied. 1048, 48A, 48B, these three are in conjunction with each other, but not totally same. They are different, applicable to foreign company and foreign company. 1048, so what happened is international transactions are all taking place in dollars, US dollar. US dollar is a monopoly, so we become over dependent on dollars. Today the dollar rate is 40 rupees, tomorrow it becomes 80 rupees, 90 rupees, 100 rupees. Then our outflow doubles up. Our outflow becomes much more than what we have a budget for. For example, we were to pay $1 for a particular item which was costing us 40 rupees per dollar once upon a time. Now it will cost us 80 rupees, 85 rupees, 86 rupees as the case may be. So you can say outflow in terms of Indian rupees gets doubled up. So India under Modi government, they started this new concept. They started offering a scheme to these foreign companies, especially crude oil selling company, OPEC companies. OPEC countries, oil producing and exporting countries, OPEC, OPEC countries, we gave them an offer that in case you are ready to deal with us in terms of Indian rupees, instead of foreign currency, if you are ready to deal with us in Indian rupees, then we will give you some exemption, which they agreed and received this Indian tax exemption. Income of a foreign company received in India in foreign currency. This is the most important condition. Income is received in Indian currency, not in foreign currency, not in dollar, from sale of crude oil in India. From sale of crude oil. Now initially this 1048 exemption was only with regards to sale of crude oil, but unexpectedly we received a very good response for this 1048, and many foreign companies, especially oil exporting company, not only oil exporting company, even other companies also selling other products, they also agreed to deal in Indian currency as compared to dollars. So we expanded the scope that not only for sale of crude oil, if the income is received or receivable in Indian currency from sale of notified goods, other notified goods, or from sale of providing other notified services, then also this exemption will be available. The only condition is they should receive their income or whatever sale proceeds they are talking about. Sale proceeds should be in terms of Indian rupees and not in foreign currency, then that foreign company not engaged in any other activity will be getting exemption. However, foreign company and the agreement both should be notified by central government in national interest. This is slightly important. This used to be important. Nowadays you can ignore it, but I am please marking it as important one. So just keep it in your mind. Next is 1048A and 1048B. Now here in 1048, the income had to be received in Indian currency, which is the primary condition. Some foreign companies, they were ready to spend money in India and develop our seaport like Vizag. Vizag means Vishakhapatnam seaport, then Kandala port and certain strategically located ports which previous governments never spent a single rupee to develop them, and there was a lot of potential to develop them, but Indian government was lacking funds. So we gave them an offer, we gave an offer to foreign companies that with your money you come to India, you develop this entire port, 50% you use, 50% we will use, plus whatever 50% that you are using, from that in case you develop a port and also set up a storage facility, half of the storage facility you will use, half of the storage facility we will use, that is government of India. Whatever half you are using, in case you generate any income therefrom, then income from sale of crude oil from that storage facility, then we will provide exemption to you. So 1048A, income of a foreign company from storage of crude oil in India in a facility in India, from storage of crude oil in a facility in India and the sale of crude oil therefrom to any person resident in India, provided foreign company and that agreement both are notified by central government in national interest. Which income? So in 1048 and 1048A, what is the difference? Difference is of currency in which the business takes place. In 1048, that business should be transacted in terms of Indian rupees. In 1048A, there is no such condition of transacting in Indian rupees. The only condition is that there should be sale of crude oil from storage facility in India. 1048 applies to not only sale of crude oil, it applies to other notified goods and other notified services also. 1048A does not apply to other notified services or does not apply to sale of other goods. It applies only and only to crude oil. Sale of crude oil from storage facility in India. That storage facility would have been developed by that foreign company only by investing in India, for which Indian government welcomed them and Indian government gave them a lollipop that we will not charge you tax under Income Tax Act provided you set up with your own cost. However, here agreement will be valid for a period of 20 years ideally. Now what in case if the period has expired? After expiry what to do? Answer, renew the agreement. Answer, what if the agreement is not renewed? Answer, then exemption will stop. But what if there is a stock of crude oil which is left over during the period when the agreement was in force? Agreement was in force, let's say till 31st December 2024. Whatever crude oil was stored there, from sale of that crude oil, if any income now is earned by foreign company after the expiry of agreement. So and for that, government introduced 1048B, 1048A and 1048B, they both go hand in hand, they both are on the same lines. Income of foreign company from leftover stock of crude oil. Earlier it was only crude oil, now it is leftover stock of crude oil from facility in India after expiry or after termination of that agreement referred to in 1048A. So 1048A and 1048B have to be read in conjunction with each other. Last point is 1050, income from providing, this is with regards to equalization levy which we are already done with. There are two types of incomes which attract equalization levy. One is 6% on which is to be deducted by the payer, 6% on the amount with regards to amount which is in the nature of payment for specified services and the amount exceeds 1 lakh rupees, then similar to TDS, the deductor, the payer of the income will have to deduct 6% equalization levy. This 6% is to be deposited with the government account by 7th of the next month. That's what we discussed. 6% is on online services, online advertisement or provision for digital advertisement space. And there is one more 2% applicable on e-commerce operator, whereby payer will not deduct, but e-commerce operator, when he receives money from customer, he will have to pay from his own pocket 2%. This 2% is deleted with effect from 1st August 2024. We all know about it. We have discussed it in equalization levy chapter. So that income on which 6% equalization levy is deducted by the payer will be exempt in the hands of non-resident or a foreign company which is not having permanent establishment in India, which is not having any branch in India. So income from providing any specified service in India, specified service would mean online advertisement, provision for digital advertisement space, or providing of any other service or facility in connection with digital advertisement, or any other service as may be notified by central government. Up till now, nothing is notified by central government. Covered by Chapter 8 of Finance Act 2016, that we know pretty well. For equalization levy, there is no specific separate chapter or there is no specific law. It's just that it was introduced as a part of Finance Act 16 by Arun Jaitley ji. Apart from introducing ICDS, GAR, equalization levy, he introduced many more things, but these were the key features. This exemption is no more available on income which is treated as royalty or FTS under the Income Tax Act and which are deemed to accrue or arise in India as per section 916 and 917 will be deemed to be taxable in India. No exemption, will be taxed as per rate given in 115A subsection 1 clause B, will be taxed at a flat rate of 20%. Provisions of 916 and 917 will be applicable, whereby 916 is for royalty, 917 is for fees for technical service, which will be applicable. Okay, with that, exempt incomes are over pertaining to non-residents of foreign company. We discussed everything except a few clauses which we left pending. I don't think so you will be able to remember everything. We skipped 10, 4E, F and G, which were totally unimportant, so we skipped them. With that, this video comes to an end. Wish you all a very good luck. See you in the next video. In the next video, I'm planning to discuss place of effective management, POEM, for determining residential status of a foreign company. Now, I'm not continuing that particular chapter here for a reason. Many people want to study only POEM or want to revise only POEM, don't want to do this exempt income part. That's why exempt income I've covered in part 2. Many people are interested only in part 1 and many people are interested only in POEM. So POEM I'm recording as a separate video. This video I'm ending here only. See you in the next video with place of effective management.